Economists are becoming an awfully gloomy bunch, some warning that the worst may not be over for oil-shocked Canada. In the space of less than a week, several groups have released reports that paint a bleaker picture, questioning the Bank of Canada's forecasts and wondering how policy-makers will react. Of course, the Bank of Canada wasn't all that upbeat in its latest projections, either. The persistence of low oil prices means the worst may not be over for Canada, said Krishan Rangasamy of National Bank Financial. Lower projections for oil prices should lead to further cuts to investment spending and hurt growth, he added. We have accordingly downgraded our 2016 growth forecast to just 0.9%. At its most recent meeting, the Bank of Canada held its key rate steady, tossing the ball to the new federal government, which will unveil its stimulus plans in its coming budget. But observers wonder how strong those measures will be, and question whether the Liberal government of Prime Minister Justin Trudeau will need to go further than planned. We'll need to see a more forceful and timely fiscal policy response in the upcoming federal budget than what was promised during the election campaign to paper over oil-induced weakness and put off the broader stall in Canadian growth we now fear, Mr. Rangasamy said. And just today, CIBC World Markets cut its forecast for economic growth this year to 1.3%. Even to achieve that pace, we're allowing for an additional $10 billion in stimulus relative to the election platform and a $30 billion federal deficit, and a slightly weaker track for the Canadian dollar, said Chief Economist Avery Schenfeld. Oil prices climbed today, by the way. Here are 6 charts that tell the ever bleaker story. Asterisk. 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 While Mr. Rangasamy's National Bank is on the gloomier side, economists as a group have been cutting their projections. While the impacts of the oil shock on the Canadian economy are complex, it's clear much of the initial drag on growth came from investment spending as evidenced by the precipitous drop last year, Mr. Rangasamy said. Sadly, the investment collapse is far from over. It's not just oil. Adding insult to injury, Canadian manufacturing output was roughly flat in 2015 versus a 2% rise stateside, said BMO Nesbitt Burns chief economist Douglas Porter. Canadian auto production fell 5.5% for all of last year, to its lowest level in 4 years, even amid a record year for vehicle sales in both the US and Canada, he added. Ouch! Assemblies for all of last year were 2.3 million units, aside from the troubled 2008-11 period, that's the lowest level of annual auto production in Canada since 1993 and down 24% from the all-time high in 1999. The pain is spreading. Energy producers remain in cost-cutting mode due to the persistence of low prices, said Mr. Rangasamy. But even outside the energy sector, the outlook for business investment is anything but rosy. Corporations are struggling to generate profits in an environment of slow global growth and limited pricing power. There is, of course, a regional divide. The energy provinces, notably Alberta, have been hit hard, but Toronto-Dominion Bank has cut its forecasts for Canada's regions, though some are expected to still see economic growth. With the past year ending more like the proverbial lamb than lion, this forecast update contains broad-based downgrades to 2016 growth prospects from coast to coast, TD economists Derek Burleton, Michael Doliga, and Diana Petramela said in their projections. The bulk of economists are still expected to expand this year, but at a slower rate than we had earlier envisaged, with only British Columbia and Ontario set to chalk up real GDP gains surpassing 2%. Take a look at those ugly yellow diamonds for Alberta and the eastern provinces. So many years after the financial crisis, Canada's jobless level has climbed back up above 7%. And according to TD's forecasts, it's going to stick at 7.1% this year and ease only to 7% in 2017. The oil-producing provinces will continue to face significant chill winds this year, the TD economists said. Real GDP in Alberta and Newfoundland is expected to contract for a second consecutive year and unemployment rates are likely to march to new highs in the coming months, they added, though they do see more stability in 2017. Made in Canada isn't what it used to be. While the faltering Canadian dollar is helping exports, the boost from that is likely to be constrained by the loss of market share and reduced industrial capacity, Mr. Rangasamy warned. Recall that despite a weaker currency and a stronger U.S. economy, non-energy exports remain well below levels reached 8 years ago, he added. So, the expected investment boost from exporters in response to better sales abroad may take a while and may not be as significant as first thought. Resource firms hit. As if to drive home the point, 2 Canadian resources companies are signaling more troubled times. As the Globe and Mail's Ian McGugan reports, Potash Corp of Saskatchewan cut its dividend as it reported a lower profit and a dimmer outlook. The company posted a fourth quarter profit of $201 million, US, or 24 cents a share, compared to $407 million or 49 cents a year earlier. Challenging conditions, including currency weakness relative to the US dollar in emerging markets, continued to weigh on fertilizer markets through the fourth quarter, it said. Cautious buying patterns resulted in deteriorating prices across all 3 nutrients as the year ended, it said, referring to potash, nitrogen, and phosphate. Chief Executive Officer Jochen Tilk cited a more cautious outlook in the early days of 2016, but added he believes conditions will improve. That was followed by Penn West Petroleum Limited cutting spending by a dramatic 90% in the wake of the oil rout. Its capital budget for the year is $50 million. Given the present state of the commodity price environment, our 2016 capital budget reflects the reality of living within our means at current price levels and managing the business on a week-to-week basis, said Chief Executive Officer Dave Roberts. Economy Minister quits. As if Japan's economy weren't in enough trouble, a key minister resigned today amid a brewing scandal. Economy Minister Akira Amari reportedly denied wrongdoing in the corruption allegations, and Prime Minister Shinzo Abe named a replacement, Nobutaro Ishihara. Mr. Amari was a key player in Mr. Abe's economic drive. Among other things, he helped negotiate the Trans-Pacific Partnership trade deal. A recent review has singled out Canada, along with 6 others, as the most indebted countries in the world. Our inclusion in this list isn't based on government, public, debt, the type that gets all the attention at federal budget time, but private sector debt that accumulates year after year and hides in plain sight. Public sector deficits were debated at length after the recent Liberal budget, but more immediate risks associated with private sector borrowing, household debt and non-financial corporate debt failed to generate discussion. Steve Keen, a professor of economics, politics, and history at England's Kingston University and author of the 2011 book Debunking Economics, believes that the 2007 U.S. financial crisis was caused by banks lending too much to finance speculation, rather than investment. In an article for Forbes published a few days ago, he says 7 countries are most likely to suffer an economic crisis in the next 1 to 3 years: China, Australia, Sweden, Hong Kong, South Korea, Canada, and Norway. It was shocking to see Canada on this list. But Richard Vague, author of The Next Economic Disaster, Why It's Coming and How to Avoid It, did the basic research that Professor Keen references and makes a convincing argument. Mr. Vague says that any country whose private debt to GDP ratio goes beyond 150% and that has a 5-year rate of growth of 18% or greater, Indiana, that ratio experiences a financial crisis at some point. The data comes from the Bank for International Settlements. These two milestones were surpassed during Canada's recent borrowing binge. Canadians collectively owe more than 208% of GDP, and private debt to GDP grew more rapidly than the guideline between 2011 and 2016. Private debt grew from 182% of GDP to 208%, well above the benchmark rate of growth for 5 years. Canada nearly qualified between 1985 and 1990, when Canada's private debt GDP ratio experienced rapid growth from 112% to 140%. But the debt GDP ratio stayed below 150%, and so Canada barely stayed below the standard. In the early 1990s, even though private debt stayed below the threshold, Canada still experienced a financial crisis when large companies failed and house prices declined by more than 20%. In 2016, Canada qualifies for a private debt crisis without caveat. When will the crisis hit? Exact timing is difficult, but it could arrive when Canadians decide to stop borrowing more. Or, more likely, when lenders restrict the availability of new credit, since aggregate demand depends on households and businesses going deeper into debt. With Canadian private debt growing at more than 5% a year and GDP growing at 2%, it will get ever more difficult to manage the debt burden. First, existing debt must be rolled over and interest on that debt paid. Second, for the economy to keep growing, borrowers must add new debt to finance an expansion in consumption, business investment, real estate, automobiles, and speculation. At more than $4 trillion, Canadian private debt has become a leviathan that must be fed. The coming crisis can be delayed but not averted. For example, in 2006, a change in government policy accelerated the incipient borrowing boom when 40-year amortization and zero down payment guidelines were introduced for housing loans. The debt burden was lightened when interest rates fell to extremely low levels not experienced for many decades. Lenders relaxed their standards by allowing loans on easier terms. And borrowing continued to grow when shadow lenders provided loans to marginal borrowers rejected by banks. But these factors can provide only temporary relief while adding fuel to the fire for the eventual crisis. When the crisis nears, a warning sign will appear as a drop in the rate of private debt growth. This ebbing of new money flow will reduce demand and, if it persists, will bring on recession. Lenders will pull back, worsening the recession, leading to an increase in bankruptcies and even more caution among lenders. Elected officials will become alarmed and take action. Canada and Norway are fortunate to have a relatively small amount of public debt and a AAA credit rating, and therefore are in good position to mitigate the severity of the crisis. Professor Keane points out that the countries on the list are at different stages in this cycle, with Hong Kong in the lead. In that region, a decline in the growth of private debt began in 2014. If the rate of growth continues to decline, Hong Kong could be the first to reach a crisis. If you want a preview of what could happen in Canada, keep an eye on what happens there.